Hello everyone, welcome to the 144th episode of me learning how to trade in Forex. So in the last episode we finished off bet types and costs. So all spread bets have a fixed time scale which can be from minutes up to several months or even theoretically years. The fixed date and time which your bet you will end is known as its expiry. This is the maximum time until which you can hold your position, although you can choose to close it before it expires. So bets fall into two main categories based on the expires. So we've got daily funded bets, which basically stays open for as long as you want, and they're given a nominal expiry date at some distant point in the future. But you're free to close your position at any time before this, whenever the market is actually open for trading. So if you do want to keep the daily funded bets open overnight, most providers will charge you a fee for doing so. So this fee is called a financing cost or overnight funding charge. So for each day your position remains open, you have additional financing costs or overnight funding charges. So this generally means that daily funded bets are used to speculate on short-term market movements only and not the long-term. And then we've got the quarterly bets. So quarterly bets are bets that expire at a specific date before the end of a given quarter. However, just like the daily funded bet, you can close your position at any point before the expiry date when the market is open. And then you can roll quarterly bets over into the following quarter if you let your provider know beforehand, although there may be a charge for this. So the cost of keeping a quarterly bet running to its expiry date is factored into its quoted price. So that means the price for quarterly bets is typically different from the underlying asset value, whatever you're trading or betting, and the spreads on quarterly bets are often wider than daily funded bets. So for this reason, the quarterly bets are usually used for longer term positions. And then we got the cost of spread betting. So spreads, there are a few other costs associated with spread betting. So these applies whether you win or lose. And we got the margin. Basically, as we've known in trading, margins, the deposit you need to control a larger amount of money. So yeah, we explain. Different spread betting providers require slightly different levels of margins. Rates tend to vary across markets according to the underlying conditions. And then we've got currency conversion fees. So when you spread bet in another currency, for example, if you're in the UK and spread bet in something in the USD, then that currency then the GBP has to be converted to USD, or vice versa, when transactions happen. So yeah, and that is probably going to incur a fee from the provider. So watch out for that. And we've got the extra charges, basically controlled risk premiums. Spread bets can be subject to slippage, so you may be able to protect yourself by paying a small fee for a guaranteed stop. And then we've got feature subscriptions, such as different charting softwares, live prices, etc., that the provider can give you. But yeah, that's that. And then we went through a lesson summary. So now we're on to why do people spread bets, which is already written down. The date is the 23rd. So why do people spread bets? We've looked at spread betting. We've looked at what spread betting is and how it works, but you may be wondering about the advantages of placing a spread bet rather than trading in a more traditional way. Let's take a look at the reasons to choose spread betting. Tax-free profits. When you trade financial assets in the traditional way, you normally have to pay capital gains tax on any profits you make. So when you trade financial assets in the traditional way, you normally have to pay capital gains tax on any profits you make. However, spread betting is classed as gambling, which is exempt from CGT. However, spread betting is classified as gambling, which is exempt from the capital gains tax. It's also free from stamp duty, a tax you typically face when trading shares. It's also free from stamp duty, which is a tax you pay you face when trading shares. That's because you never physically own any assets. With spread betting, you just bet on their value, as you never physically own the asset. Remember that tax laws are subject to change and depend on individual circumstances. Tax law may differ in a jurisdiction other than the UK. No commission. If you trade physical financial assets through a broker, you normally pay commission. This doesn't apply for spread betting, as the charges are typically included in the spread. Since brokers often charge a minimum fee for every transaction, paying spread is usually cheaper than paying commission on an equivalent transaction, particularly for smaller sized deals. Since brokers often charge a minimum fee for every transaction, paying the spread is usually cheaper than paying commission on an equivalent transaction. Spread, you don't need to pay commission for spread betting, as the charges are typically included in the spread. Capitalizing on falling markets. In traditional trading, you may normally buy an asset and hope its value will rise so you can sell for a profit. However, spread betting can equally well take a view on an asset you expect will fall in value, known as going short. Or it can go short in normal trading, right? As you're simply betting on the direction you think a price will take, you can keep dealing even bearish. You can keep dealing even in bearish markets. Right, okay. You can deal in bearish markets when spread betting. Thousands of markets. With traditional trading, you might have to use separate brokers specializing in different asset types such as shares or foreign exchange. However, most spread betting providers offer a diverse range of global financial markets, all together on a single platform. You can also spread bet on markets that are difficult to access in other ways. Stock indices, for example, can't be bought or sold directly, but you can spread bet on their movements. Most spread betting platforms offer a diverse range of global financial assets markets all together on a single platform. "24-hour dealing. Most markets have set dealing hours. The FTSE 100, for example, is only open from 8 AM to 4:30 PM in the underlying markets. Ordinarily, after it closes for the night, you have to wait until the following morning before you can deal. You may, however, find that some spread betting providers allow you to deal around the clock on certain markets. This means that even if the market betting is shut, you can still open and close your bets. Some spread betting providers allow you to spread bet 24 hours a day on certain markets. Leverage. With conventional trading, you generally need to pay the full purchase price of an asset up front. Spread betting, however, is a leverage product, so when you place a spread bet with your provider will ask you to put up a sum representing just a fraction of the total value of the position. Leverage gives you a relatively large exposure to a market with just a small deposit. Yep. Imagine you want to spread bet on gold. Without leverage, buying 1 ounce of gold might cost £800, but your spread betting provider only charges an initial deposit margin of 1%. This means you need to put down a deposit of just £8 to open a position on an ounce of gold, which costs £800. So leveraged exposure require capital, unleveraged exposure capital requires the same. Cool. Question: you're looking to take a position on shares in insurance company Z. Each share is currently worth £5. If you bought 200 shares without leverage, how much would the transaction cost? 5 times 200 is 1,000. When you trade shares without leverage, you have to put down the full value. In this case, that's £5 times 200 is 1,000. Your spread betting provider, however, only charges an initial margin deposit of 5% to open the equivalent position. How much money would you have to put down? So what's 5% of 1,000? £50. The upfront cost of this trade is 5% times 1,000 is £50. The risks of using leverage. Leverage can work to your advantage when you spread bet. However, it's important to remember that both profits and losses are based on the full size of your bets. This means they could far outweigh the size of your initial deposit, so leverage is a benefit of spread betting, but also its biggest risk. You can look at leverage in more detail in the orders execution leverage course, which we've done. So let's just summary then. Spread betting profits are tax-free and exempt from stamp duty. Tax laws are subject to change and depend on individual circumstances. Tax law may differ in a jurisdiction other than the UK. You can go either long or short. Spread betting gives you access to thousands of markets in one place. You can spread bet 24 hours a day on some markets, e.g. Forex and major stock indices. Spread betting is a leveraged product, so you won't have to put down the full amount of your position. As such, both your profits and losses may be magnified in relation to your initial deposit. Cool. So, what are contracts for differences? So spread leverage can be used in spread betting. There we go. Similarly to spread betting, when you trade a contract for difference or CFD, you're not actually trading a physical asset. Instead, you're agreeing to exchange the difference in value of an asset between the point at which the contract is open and when it is closed. So when you trade contract for differences, you're not actually trading a physical asset. You're not trading a not physically. What's that? Asset. Okay, there we go. Instead, you're agreeing to exchange the difference in value of an asset between the point at which the contract is open and when it's closed. Instead, you're agreeing to to exchange the difference in value of an asset between the point at which the contract is opened and when it is closed. You're agreeing to exchange the difference in value of an asset between the point at which the contract is open and when it's closed. Contracts for differences are derivatives, as the price of a CFD is derived from the value of an underlying asset. Contracts for differences are derivatives. As the price of the contract for difference is derived from the value of an underlying asset. So whatever the underlying asset price is, the price of the contract for difference is that. For example, you might open a CFD based on the price of gold with the expectation the metal will rise in value. If the price of gold does indeed go up and you then close the contract, you will have made a profit. If it drops, you will have made a loss. Of course, the more the market moves in your favour, the more money you can make. And the further the market moves against you, the more your losses will stack up. Also, as you never own the physical asset, you can potentially profit from both rising and falling prices in the underlying market. In other words, you can go long or short. So, the more the market moves in your favour, the more money you can make. The more the market moves against you, the more loss you will, the more the loss will increase. So you can go long or short for contract for differences. This is probably beginning to sound quite familiar. At a first glance, spread betting and CFDs can appear almost identical. Even the way CFDs are traded is remarkably similar. Trading a CFD, just like a spread bet, you'll see two-way price quoted on each CFD market offered. Let's use silver as an example. Suppose it's currently being listed by one provider at a spread of 1650-1653, which is equivalent of $16.5 and $16.53 in the underlying markets. 1650 is a bid price at which you can sell, go short. 1653 is the offer price which you can buy, go long. If you believe the price of silver will rise, you will buy at the offer price, so 1653. Or if you think it will drop, you sell at the bid price, so 1650. As with a spread bet, you'll be asked to put up a margin payment as a deposit to open your position. However, things differ when it comes to deal sizes. With spread betting, you bet an amount of money per point, but CFDs are traded in standardized contracts, sometimes called lots. The sizes of these contracts differ depending on the asset, often mimicking how that asset is traded in the underlying market. It's traded in the underlying markets. It's got the buy and sell price. Sell price is going short. Buy price is going long. As with spread bet, you'll be asked to put a margin as a deposit. Yep. However, things differ when it comes to deal sizes. Spread betting can bet amount, but CFDs are traded in standardized contracts. Contract for differences are traded in standardized contracts, sometimes called lots. The size of these contracts differ depending on the asset, often mimicking how the asset is traded in the underlying markets. Going back to silver, it's traded in contract size of 5,000 troy ounces in the underlying markets. Therefore, most CFD providers also offer silver in contract size of 5,000 troy ounces. This works out to be equivalent of 50 per point of movement. $50 per point of movement. So, the size of these contracts differ depending on the asset and often mimics how that asset is traded in the underlying markets. Cool, so lesson summary. A CFD is an agreement to exchange money according to the change in value of an underlying asset. It is a means to gain exposure to the change in value of a financial instrument without actually owning that instrument. Traders can take a long or short position on a CFD, potentially enabling them to profit from falling as well as rising prices. CFDs are traded in standardized contracts called lots, which differ in size for each asset. How a CFD trade works. So how a CFD trade works. Now that we know you can trade on a financial asset such as silver using a CFD, let's take a look at how you might go about taking a position. Say you think the price of silver will rise, so you decide to buy 5 CFD contracts at 1653. A week later, the price of silver is quoted by a provider at 1683, 1686, and you think it's time to sell and close your position. Your profit or loss is calculated as the number of contracts you traded, multiplied by the value of contract per point of movement, multiplied by the difference in points between the opening and closing prices. So in this scenario, you would have made $7,500 because 5 contracts times by $50, which is where's that 50 from? Value of contracts per point of movement. So value of the contract per point of movement. So each point is $50, and you've got 30 points between the opening and the closing. So opening 1653, closing 1683, 1683 minus 1653, that's 30. So times them all together, $7,500. Not bad at all. In a week. That's very good actually. Oh my god, that's insane. You might also need to factor in commission or other charges, as we'll explain shortly. Okay. The number of contracts you choose to trade is up to you, but always remember that the value of one contract will vary from market to market and may be denominated in different currencies. For example, one contract of the FTSE might be worth £10 per point of movement, while one Nikkei 225 contract might be worth just $5 or around £3 per point. When trading share CFDs, the contract size is usually equivalent to one share of the company you're trading. So if you wanted to buy the equivalent of 1,000 shares of Vodafone, you would simply buy 1,000 Vodafone share CFDs. Right, okay, so how to trade contract for differences. So buy a number of contract if you think the asset's value will rise. Whoa. And then sell and close your position when you're ready. Oh no, my god. Okay. Profit or loss. Profit loss is equal to number of contracts traded value of the contract per points of movement so times difference in points between the opening and closing prices. The difference in points between the opening and closing prices. So you might also need to factor in commission or other charges. Number of contracts you choose to trade, up to you. Number of contracts you choose to trade is up to you. I should probably move this to up above somewhere, so contract by X amount of contracts. The number of contracts you choose to trade is up to you. You think the asset's value will rise? Yep. And then, yep, so you might remember that the value of one contract will vary from market to market and may be denominated in different currencies. So then there might be a currency conversion fee or somewhere, something like that. When trading CFDs, yep. When trading share CFDs, the contract size is usually equivalent to one share of the company you're trading. So if you want to buy equivalent of 1,000 shares, you simply buy 1,000 Vodafone share CFDs. Cool. Banking Company B is offering a CFD provider at 565,567, the equivalent of a bid price of £5.65, an offer price of £5.67 in the underlying market. You think the price of Banking Company B will rise, so you decide to buy 10,000 shares as a CFD. Later that week, Banking Company B is offered at 577,579. You decide to sell and close your position, ignoring commission or other charges for now. How much profit or loss have you made? So it's basically, what is it? You managed to sell it at 577, but you bought it at 567. So 577 minus 567, that's 10. So it's 10-point difference. 10-point difference times by how many contracts did you buy? 10 points difference. 10,000. So 10 times 10,000, that's 100,000. £100,000. How much is of movement? How much is a movement per point? You definitely profited. The price of banking company B rose by 10p per share between opening and closing position. So you made 10,000 times by 10p is £1,000. To calculate net profit, you will need to deduct any other charges like commission or overnight funding. We'll explain these below in the next section. Oh, so just 10,000 times by 10p. Okay, fairs. I thought you would have to add like that, but we already know each move is worth 10 pence. Oh, right, okay, so that 10 pence is pretty much that. Oh, right, I see. So, yep. So that 10 pence is basically the value of the contract per point of movement. Right, okay, makes sense. And then we got the number of contracts. Yeah, okay. Overnight funding charges. Just like when you open a daily spread bet, when trading CFDs, your provider will generally charge you a fee for holding position overnight, unless you're trading futures, forwards, or digital hundreds. So your provider will generally charge a fee for holding position overnight. These are called financing cost or funding charges and reflect the cost of borrowing or lending the underlying asset. So each day your position remains open, you incur additional costs. Why trade CFDs? Many of the arguments for trading CFDs in lieu of conventional trading are the same as for spread betting. With CFDs you can go long or short, trade using leverage, i.e. on a margin, access some markets 24 hours a day. Right. Yep. Did you know, when trading on margin, a minimum margin level must be maintained on open positions at all times. Providers typically calculate the profit, loss and margin requirements constantly in real time and display it for their clients on the screen. If the amount of money deposited drops below the minimum margin level, providers will ask for more money to cover the position, known as a margin call, and may even close them if the losses get too large. Yep. Margin calls, not good. All times. So, when trading on margin, a minimum margin level must be maintained on open positions at all times. If the amount of money deposited drops below the minimum margin level, providers will ask you for more money to cover the position, known as a margin call, and may close them if the losses get too large. and may even close them if the losses get too large. Of course, the same risks apply for CFDs as to spread betting, and it's important to remember that your losses can be higher than the deposits you make to open your positions. So lesson summary: profit/loss equals number of contracts traded times by value of the contract per point of movement times by difference in points between opening and closing prices. Funding charges usually apply if you hold a CFD open overnight. If the money held in your account drops below the level needed to cover your positions, you receive a margin call. CFDs have many of the same benefits as spread betting as well as the same risks. So how CFDs differ from spread betting? So how CFDs differ from spread betting. So far we've emphasized is that CFD trading closely resembles spread betting. However, although these two derivative products are very similar in many ways, there's some key differences to be aware of. Deal size. Spread betting and contract. I'll call it CFDs. So difference between spread betting and CFDs. Deal size. As mentioned earlier in this course, when spread betting, you bet an amount of money per point on whether the market will go up or down. For instance, you might bet £5 per point that the price of the FTSE 100 will fall. With CFDs, you buy and sell contracts that represent a specified amount in the underlying market. For example, one standard FTSE contract might be worth £10 per point. When spread betting, you bet an amount of money per point. With CFDs, you buy and sell contracts that represents a specified amount in the underlying market per point of market price movement. Cool. Capital gains tax. Spread betting profits are currently free from capital gains tax, but CFDs are liable because they are classified as a financial instrument. Spread betting are free from capital gains tax. CFDs aren't, as they're classified as a financial instrument. This may seem like a major drawback, but any losses can be offset against future profits for tax purposes, which makes CFDs good for hedging. Any losses can be offset against future profits for tax purposes. Note that stamp duty on share trades doesn't apply to either spread betting or CFDs, as you never own the underlying assets in either case. Tax laws are subject to change depending on individual circumstances. Tax law may differ in a jurisdiction other than the UK. So, stamp duty doesn't apply to either. On shares doesn't apply to either. Spread betting is free. Did you know what is hedging? If you have an asset an existing portfolio that you believe may lose some of its value, you could use your CFD to offset the loss by short selling. For example, let's say you hold £1,000 worth of HSBC shares in your portfolio. You can short sell the equivalent of £1,000 worth of HSBC shares through a CFD trade. Should HSBC shares price fall in the underlying markets, the loss in value of your share portfolio will be offset by a gain in your short CFD trades. But that just means that you won't be able to profit when you are right though, because it goes the other way around as well. So, expiry times. Spread bets tend to have fixed time limits, anything from minutes to several years, when they'll naturally expire if you haven't already closed them. Most CFD trades, on the other hand, will stay open indefinitely, although there are a few exceptions such as futures and forwards. When you want to close out a position, you simply place the trade in the opposite direction to which you want to open it. You opened it with. So spread bets tend to have a fixed time limit. And will naturally expire if you don't close them. Most CFDs don't. Most CFDs will stay open indefinitely, except futures and forwards. Commission charges on shares. When you place a spread bet, you are rarely charged commission. Most providers' charges are included in the spread. The majority of CFD trades are the same, though in the case of shares, many CFD providers match the price of the underlying market, then charge commission for carrying out the trade. This mimics the mechanics of trading shares in the underlying markets. So, when placing spread bets, most providers charges are included in the spread. Share trades providers match the price of the underlying market and then charge commission for carrying out the trade. So basically the same concept, except one charge is like hidden in quotation marks, so buried in a spread, whereas the other one is like out in the open basically. So yeah. Example, let's say you think shares in sports company N are set to rise. You could take a position of either CFD or spread bet. CFD, the shares are currently listed at a price of 1545, 1547 in the underlying markets, the equivalent of £15.45 pence and £15.47 pence. You decide to buy 1,000 shares as a CFD. Your provider offers offers the shares at market price, but charges 0.1% commission on the full value of the position. So the final charge will be calculated as 1,000 times by 15.47 times by 0.1%, so £15.47 pence. Note that although you only have to put down the initial margin deposit to open the position, the commission charge is based on its full value in the underlying market. Spread bet. You want to bet £10 per point on the price of sports company N to rise. Your provider doesn't charge commission, but the spread incorporates a 0.1% charge. So instead of being offered at 1545, 1547, the bid price now stands at 1543.45, because it's 1545 minus 1545 times by 0.1%, and the offer price is 1548.55 because it's 1547 plus 0.1% of that. You won't be charged commission on the purchases, but you've had to buy at a higher price than if you're trading CFDs. So which of the following statements apply to CFD trading rather than spread betting? Note that, yep, CFD losses can be offset. CFD normally no commission, that's not CFD. Effectively hedging that. Spread betting and CFD trading work in broadly similar ways, but there are technical variations and importantly, different taxations and charging mechanisms apply. So there's no stamp duty, you do have to pay capital gains tax, losses can be offset against future profits. For tax purposes, it's an effective way of hedging an existing portfolio. So lesson summary, trading CFDs closely resembles spread betting, but there are some key differences. Spread bets are made in an amount of money per point, CFDs are traded in standardized contracts. Profits made from spread betting are currently free from capital gains tax, but CFDs are liable. Spread bets are generally expired at a fixed time if you don't close them out first, while in most cases CFDs will remain open indefinitely. Traders generally charge commissions to conduct share CFD deals, while the charges for the spread betting on shares are usually included in the spread. Cool. That all makes sense. I am going to leave this episode here then. In the next video we're going to finish off the quiz for this section. And yeah, we're going to move on to the next beginner course that's on offer for IG, wherever it is. So, thank you all for watching, and I will see you guys in the next video. Bye.